My name is Michael Guyett, publisher of the Lead Lag Report. Our Mr. Ben Hunt, Epsilon Theory himself, here on X. Ben, for those who are not familiar with the background, yourself, who are you? What background? What have you done throughout your career? What are you doing currently?
Well, my wife says I have a hard time keeping a job. For 35 years now, I've been studying narrative. I started doing it in academia. I got my PhD in this. I wrote a book on this, and it was in the field of the very oxymoronic political science. Right? That's where I started doing this. And I think, like a lot of people on this call, I had the entrepreneurial bug. And if you are afflicted with that, you know it is a bug, not a feature. So I ended up leaving a tenured spot in academia to start a software company. You'll see kind of the common threads are all the different ways of looking at this that I've done over the years. Is it's all about unstructured data. So that was the software company. Ended up selling that and got an opportunity to start playing the biggest game in the world, which is the markets. This was in 2005, and it was my baptism by fire into public markets. I'd been in academia, I started a software company, and now I jumped into managing money. The story is that for the last now 18 years, I've been trying to figure out, well, how do you manage other people's money? How do you manage other people's money when there is this enormous disjuncture between, I'll call it the real world, the fundamental, the structured data that we get from the world and the real economy, the structured data we get from market, and what we actually do as investors, as consumers, as producers. And I think that what we are actually governed by is less the structured data, although of course that's important, of course that's real, but it's the story around that structured data. There's a pattern to those stories that we tell ourselves over and over and over again about the world and structured data, the fundamental. And those patterns are what we call narrative archetypes or story arc. So I started writing about this a little over 10 years ago, and that's Epsilon Theory. It's trying to write about the structure in unstructured data. The story arcs, the narrative archetypes that I really think drive our behavior, but drive it in actually, I think, pretty predictable ways. We've had a couple of incredible technological developments over the last 4 or 5 years, so that what we're able to do with unstructured data is stuff we could only dream about when I was building language models and doing natural language processing 30 plus years ago. It's both big data, the ability to get, as we do today with our firm, everything that's published in the English language anywhere in the world, we get. But it's even more important to have big compute, the ability to apply very straightforward network math to this vast quantity of data, to big data, but to do it in a way that's affordable and quick. Natural language processing, generative AI, building language models, it's actually, the math is not complicated, and these are algorithms that have been around for a lot of years, a couple of decades in almost every case. But it requires an enormous amount of computing power to make them work. So, yes, what I'm doing now, starting 5 years ago, started a company, a research company, to just do this, to write about it through Epsilon Theory, but to do the basic research on structural understanding of unstructured data, to identify the narrative archetype, the story arcs, particularly in markets, that we tell ourselves over and over and over again, and find ways to measure them, to see how they are born, grow, multiply, die off. Yeah, truly understand the life cycle of the narrative. So that's what I've been doing now for the last 5 years, and building investment strategies around them and talking about them on spaces like this, and writing about them on epsilon theories. Long-winded answer. It's been a long path, but it's been a professional career of trying to understand the structure in unstructured data.
Okay, so usually I almost never prepare for these kind of conversations. So about unstructured, I'm actually pretty unstructured, I think, as an interviewer, but I like to listen and then try to pivot off of different things that are said. So as you were talking, my mind went to three narrative archetypes that I think are worth touching on throughout this hour. One is what you hit on, the AI side of things. Two is the narratives around interest rates. And then the third is actually, I think, the most intriguing one, maybe relates to one and two, which is what you alluded to, which is what does it mean to actually manage money in the context of different cycles. All right, so let's first touch on the narrative structure around large language models, artificial intelligence. I get it, right? Obviously, I was wrong on NVIDIA. It keeps moving up, and AI is going to be here to stay. But to your point, it's been around for a while. It's just now the story seems to be more structured in investor minds. But there, at the same time, I think, is a disconnect between the narrative of AI and productivity potential and the second archetype, which is interest rates. Because if AI is supposed to be this great productivity enhancing tool or mechanism, you would expect that to be disinflationary.
Yeah.
That doesn't seem to be the way the market's interpreting it. So let's square those two narratives together.
Yeah. So what I mean by narrative archetype isn't specifically, AI is important or whatever it is. What I mean by narrative archetype and the way that the current AI fascination would play into that is that there is a narrative archetype, and in markets, it's the new thing. It's the new thing. And particularly in growth sectors, growth investing, growth-oriented investing, there is a language, there's words, there's a grammar that we use around growth investing. Similarly, there's a language and a grammar for value investing. They're really two very different linguistic families. And a lot of times you see this, right? So there'll be a group of value investors talking with each other and using their language. And a growth investor it's hard to communicate with that group, and vice versa. So within that linguistic family of growth-oriented investing, there is a common narrative archetype. In other words, a story pattern that's repeated over and over and over again, a script, if you will, that is about the new thing. Crypto would have been a great example of this some years ago. That narrative archetype is really done subsumed by AI. So this isn't, and none of this is saying, oh, this isn't true, or that it's overblown or anything like that. That's not the point of this at all. The point is that you can identify the life cycle of a new thing narrative, and you can map that onto consistent behaviors within that growth investment linguistic family, right? So what we do in terms of building language models is you start from a position of, here are the words and language that we always use to ascribe to a new thing. And then that plus words and language associated with AI is how you're tracking this most recent incarnation of the new thing narrative within growth investing. It is fact that you can really track how this language spreads like a virus. In fact, it is the same math that we use for tracking, that we use in epidemiology. So you calculate like R naughts and all the stuff that we got familiar with around epidemiology and tracking COVID. It's exactly the same math for understanding the spread of, I'll call them linguistic viruses within the larger media universe, the larger, we call it the ambient of all the unstructured data, everything we hear and listen to that comes down the pike. So what, in terms of its market impact, is always what we're seeing today around AI. So effective CEOs, effective corporate management, they will adopt this language into their presentations, conversations, their earnings reports around their company. And you see that consistently around any sort of new thing narrative archetype. So anyway, I'll stop there. But that's what we do. We have identified to date. I mean, there are a finite number of narrative archetypes, but it's a pretty big number. We've identified what we think are about 40 or 50 of them that we track on a daily basis today. And again, the goal is not to say, oh, this is overblown or oh, this is wrong or this is a new industrial revolution. I have my own personal opinion. I think it is closer to a new industrial revolution, the impact of generative AI. But what we're trying to do in our analysis is really track the life cycle of these narrative archetypes as they are existing within today's show. Last example I'll say of this is you see exactly the same thing in any sort of entertainment media. Favorite example is Law and Order. Right, the TV show, 600 and something episodes over 20 plus seasons. There are only a dozen scripts. There are only 12 scripts. And each of those scripts has a very similar structure. It's a 3-act play. 2/3 of the way through Act 1 of every Law and Order episode, you will be introduced to a seemingly tangential character, a friend of the victim or a family member of that's involved with the situation, a neighbor, and that seemingly tangential character will be reintroduced at the beginning of Act 3 as the crux of the whole exposition. Every Law and Order episode, all 600 of them, have exactly the same sort of structure. So what we're looking for are the structures and the language associated with them. And then we can apply that to today's particular episode. That's right. Which, as you point out, in this case, is AI is the new thing within that growth investment environment. Yeah.
Is separate from the discussion about whether it's overblown or not, is it fair to say that the half-life, for lack of a better way of saying it, that the length of time that the life cycle, these new thing narratives is just getting shorter and shorter? So it could be revolutionary, maybe because of attention spans. People are just like, all right, well, I guess that's going to be happening, and that's it.
But it's a great question. And what you find is that you have different life cycles for different types of narrative archetypes. What do I mean by that? What I mean is that we differentiate between what we call our micro narratives and macro narratives. And it's exactly the same distinction you would make between microeconomic and macroeconomic. Micro narrative, like microeconomic, are the attributes of narrative or these narrative archetypes that are always present, that you can apply to every stock, every asset class, every market, every economic activity. For example, I'm bullish about X. I think Y is cheap. These narratives around I think something is cheap or I think something's expensive, I'm bullish about something or I'm bearish about something. These are what we think are the 4 micro narratives. The life cycle of these micro narratives, I think, absolutely is getting shorter. So in the past, for example, you would get the Wall Street storytelling machine, start banging the drums around, I don't know, consumer discretionary. Oh, look at these earnings reports out of XYZ company. Man, consumer discretionary, we're really excited about that. We're very bullish about this space and about that sector. In the past, I'd say that narrative would have a life cycle of 3 or 4 weeks. I'd say from drumbeat begin, drumbeats peak, drumbeats fade away to be replaced by another, I'm bullish on financial. You see this pattern. This is it's called the bread and butter narrative game of Wall Street. Wall Street, like Hollywood, our business is in creating stories. A multiple is a story. And what you see frequently on these micro narratives, I'm bullish about something, I'm bearish about something, is that they typically would have this 3 to 4 week life cycle. We're absolutely seeing the life cycle of that compressed. Right? So you can go from starting the drum beating to forgetting about it and having it replaced by something else within a couple of weeks these days. Rule of thumb, once one of these micro narratives hits your Bloomberg daily email, that's pretty much peak drum beating. And you can probably start to fade it and then to be replaced by something else. So I would say on the micro level, the drum beat, the life cycle has absolutely compressed. On the macro narrative, things like the Fed is hawkish, the Fed is dovish. We are, or business cycle narratives, we are leaving a recession environment and we're going into a recovery environment. We're leaving early stage growth into a mid-cycle slowdown. All these stories that we tell ourselves about business cycle, all the stories we tell ourselves about central bank dovishness and hawkishness, I'd actually say that I don't see those compressing. Right? The new thing narrative, AI being the new thing, these narratives, they go on for a long time. And the reason they do is I think there are motivated missionaries behind them. A missionary is a famous person, a CEO, central banker, anyone on CNBC or Bloomberg who presents an opinion about business cycle, what should the Fed do, is AI a big thing? What we see more and more is that these narrative archetypes, these macro narrative archetypes, they're more, or the usefulness of them, I think, is that you can be, I'll call it pro-cyclical, to use that sort of word. You can press these narratives in the way that I was describing, you want to fade the micro narratives when they hit your Bloomberg inbox. I think you can press these macro narratives because in all cases, you have CEOs who've adopted the language, for example, of promoting AI. You've got central bankers who want to promote the language of, we want the market to behave the way we are talking. There is a pro-cyclical or ability to press and extend these macro narratives that is a different dynamic than in the micro narrative. Again, a long-winded answer. I'm appreciative of this kind of forum where we can talk about this at length. But we really see different dynamics between what we call micro narratives, which are compressing, which are getting shorter in time frame, and the macro narrative, which we see is actually expanding a bit in their time frame because you've got an ability for missionaries like CEOs, like central bankers, to promote these narratives over a longer period of time.
Yeah, and I think that makes sense. The macro narratives, because of the nature of macro being more complex, probably should take longer and can be pressed, which we'll hit on. But I'm curious to hear your thoughts on at what point is a narrative, is a life cycle on the micro side, maybe a distraction for the macro, right? As AI mania was running wild throughout that May-June period, just looking at the macro environment, looking at most stocks beneath surface, the reality is equities outside of the large cap AI names and tech names haven't done all that much. So that narrative became a distraction for deterioration, I'd argue, in terms of what's happened.
So
the dynamic.
Yeah, I think the important, we don't think of it so much as a distraction, but we think of it in terms of a crowding out effect. And what I mean by that is the way we see human investing or in human politics also is that we're essentially it's a limited attention model of human behavior. We've only got so much bandwidth to pay attention to the messages that we are inundated with 24/7 today, right? So we all carry around our little dopamine machine. We're having this conversation on one right now, by which I mean our iPhone or whatever your smartphone device is. And one of the big changes and the reason why we find our narrative signals become stronger and stronger over time, and the stuff we're talking about work for systematic strategies 15 years ago, but they really work today. So every year, the impact of our signals and what we're looking at, it gets stronger and stronger because we embrace the stories and the storytelling more and more. I mean, my smartphone's the last thing I look at when I go to bed. It's the first thing I look at in the morning. I think a lot of us are that way. I get nervous. I get uneasy if I'm away from my phone, if I don't know where it is for more than a minute or two. And I'm willing to bet a whole lot of people on this call are the same way. We are, and it's in a purely clinical sense, addicted to this, and we've done this to ourselves. So we have a brain that has a finite capacity for paying attention to messages at the same time that we have willingly opened ourselves up to being inundated by messaging more and more and more. It makes it hard for Wall Street because, like I say, their bread and butter of Wall Street storytelling, particularly on the sell side to institutional investors, is to create a story around a sector. That's what large cap investing is, right? And large cap investing is not stock picking, it's sector picking. And so this whole edifice within Wall Street, I'm focusing on the equity side of Wall Street right now, the sell side, but the whole edifice of equity sell side is based on sector picking. And that requires a story. Oh, I'm bullish on financials. Oh, I'm bearish about energy. And that storytelling does, in fact, more and more get crowded out by, I would say, the very effective and loudly broadcast messaging of central bankers, politicians, I'll call it, macro missionaries. You're absolutely right that there's a crowding out effect here, so that the usual, oh, I'm bullish on this, I'm bearish on that you would get from analysts on the sell side, it does get drowned out or crowded out in the attention that we pay to things. That is absolutely, and it's a real, I got to tell you, it's a real challenge for Wall Street, for the sell side, this crowding out effect and their inability to construct these bread and butter day in, day out narratives about sectors. It's a real challenge.
But it's interesting because I would argue that the story stock phenomenon really went vertical post COVID, whereas the sector dynamic was always more the traditional way of thinking about where to position into, to your point. And there's a lot of studies that prove that out, right? Sector picking it's about identifying where the school of fish is moving, not the individual fish, right? That's moving that way. Good.
Yeah, no, so look, this was one of the first lessons I learned when I was just getting into this investing game we play. And so I was part of a larger firm that was long only, and one of the founders of the firm, I remember talking to him, and it was him, and he had one analyst to manage the $4 billion large cap fund. And I was talking to him one afternoon and said, David, what are you doing? You've got your analyst making these 50 spreadsheet or 50 worksheet spreadsheets on Google cash flow and calculating DCFs. And I said, yeah, you can't think that means anything, right? What are you doing? You're managing a $4 billion fund with one analyst, and I know what you've got him doing. I can't make any difference. And Dan, you got to understand, this is in 2007, 2006, 2007. You got to understand the model. This is all for show. So that when I've got one of our investors coming in, I can show them, oh yeah, we do all this, we do the work on our holding, because the holdings are all expressed in individual stock. That is not the game. Large cap equity investing is sector picking, not stock picking. And this has been the case for a long time. This has been the case for a long time that it's sector picking, not stock picking. I do think, to your point though, Michael, it's become more challenging to do the sector picking, at least based on the sort of fundamentally the fundamental stories that were the bread and butter of sell-side narratives for why you should favor this sector or that sector. The truth is, and this was the thing I learned from the founder of this firm, is what he looked at is flows. He looks at flows that, and I think that's where you can still, there's possible to have an edge today. If you have the ability, there is alpha that you can find in understanding flows, and there's alpha, I really do, that you can understand by understanding unstructured data and how that impacts what we pay attention to. Because this is how we pull it together. Right? What in this limited attention model of human behavior, the thing that drives behavior is what are you paying attention to? It ain't sentiment. It's not fundamental. It's all storytelling. What we're trying to figure out is what are the stories that are capturing more of the investing community's attention, and where are you on that story, on the life cycle of that story? Now, I can pull that directly into, how you would, or how we've applied that to thinking about inflation and treasuries, if you want.
Now, let's get into it with treasuries, with interest rates. I asked you that question via DM saying, what do you want to talk about? You said rates going higher.
Yep.
I always go back to speaking about narratives and the way people think about things. Rates can go up and down at the same time because it's a function of what rates we're talking about. And it's more than just duration, it's also about credit, right? Let's distinguish for the audience which rates you think could be rising further, and maybe what the narrative is missing, and the popular narrative is missing around the cost of capital.
Okay, so what I'm talking about I want to focus on treasuries. So I'm talking about rate. I'm talking about interest rates. I'm talking about government debt. Right? And we can talk about any sort of tenor or time frame on this, but I'm particularly focused on the long end or longer dated interest rate. So for shorthand, we can say I'm talking about 10-year treasury. I'm also talking about 30-year treasuries. I'm not so much talking about 2-year treasuries. I'm talking about, let's focus on 10-year treasury. And it's not that the market is missing anything with the narrative. My point is the narrative, its presence or absence, is what determines what the price is, what the behavior is. For example, late July this year, I'll tell you, starting in late June, then through July, we saw the recession is near narrative disappear. It was replaced by, there's no hard landing. Maybe it's a soft landing. You can just you can do simple-minded stuff like Google searches. What attack Google searches on things like soft landing, and you see that phrase just skyrocket during the late summer of this year. I say late June into July. More generally, what we're seeing in our measurement is that all of the missionaries who were saying, there's a recession that's right around the corner. Yep. Man, I think it's going to be a hard landing, or, this is going to be tough. They all vanished. That narrative disappeared. It died. The recession is coming. Recession is near. Hard landing narrative, which is absolutely one that we track because we're telling ourselves these stories about what's next in the business cycle all the time. And the language around recession stopped. So why is that important? Well, the reason that's important is that forcing people to pay attention to think, maybe there's going to be a recession next quarter. Maybe hard times are right around the corner here. If that's what people are paying attention to that story, that acts like a weight on the long end of the interest rate curve. That is a weight on 10-year treasury rate. You see what I mean? If that's what we're paying attention to, then that is one of the things that gets people to buy 10-year treasuries. And so price up, rate down. Once that weight goes away, then all the other stories that lead 10-year treasury interest rates to go up, once that weight is removed, it's going to go up. So this is something that you see from an analysis of narrative world, that when a narrative is removed, when it dies, that's as impactful as when a narrative is born. Right? So that's what we're trying to do. We're trying to track the life cycle of these stories we tell ourselves over and over again. And in June and July of this year, the story that recession is about to happen, it vanished. It died. And so we started writing about in, I guess it was first week in August, saying there's a real chance here that long-term interest rates become unmoored. The absence of this narrative that kept rates damped down, once that's removed, rates are going to go up, and we think they're going to go up quickly. Now, there are other narrative catalysts that I think are still to come. My view is, and you saw this, there's a pattern in any narrative-driven trade, is that the easy money in this trade has already been made. That once the trade becomes discovered, meaning that once mainstream missionaries come out and say, oh my goodness, interest rates could go up to 6%, 7%, which is what you saw 2 weeks ago, where Larry Fink, Jamie Dimon, really, I'll call them very mainstream missionaries, come out and say, hey, this is going to go a lot higher. That actually, for the time being, I think, puts an end to the trade. It's the first battle and the battle's over, because what you learn in trading is that you make your money in what I like to call the discovery phase, when it's only kind of fringe missionaries like me or Jim Bianco talking about this stuff. Once mainstream missionaries start talking about it, then everyone's paying attention to the trade. And so it actually becomes more difficult to make money from there. So I think that right now we're in this kind of range for 10 years probably between 4.6 and 4.8. That's the range from the first narrative catalyst, Recession 8 happening, from its impact. Now, I think there are 3 or 4 more additional narrative catalysts that we want to be looking at from here. And I think that, my personal view, when we see one of these additional narrative catalysts start to take root, I think we're in line for another leg up in interest rate. Happy to talk about those other narrative catalysts we're looking at, but this is a general idea. When you're trying to make investments based on narratives, you're looking both for the presence of a new narrative, but you're also looking for the decline or death of an old narrative. Not that it goes away forever, but that it's at both the peak of narrative activity and the absence of narrative activity where you get, we think, really strong signal for taking positions in things like 10-year Treasury.
Which goes to something I always say, which is that you can be bullish and bearish at the same time, depending upon which narrative is strongest to fade against or push. I think what you're hitting on is the path point I try to keep stressing.
Yep.
So you could end up having 10-year yields go to 6, 7, 8% for all we know. Doesn't have to happen next year. It can happen over multiple years, but in between now and then, you can have some of these real tradable, if you're going to trade treasuries, tradable opportunities where you're fading the mainstream. I forget the term you use. Those disciples, whatever you want to call it. That they're talking about. Well, you're worried about this now, right?
Yeah. So look, other kind of lessons over a lot of years of investing. Markets happen on the margin, and what that means is it is the marginal buyer or seller that determines price going up or down. Marginal buyers and sellers are driven by catalysts. My old hedge fund, it's a defined category, right? Value with a catalyst. And I think if you look at fundamental investing, certainly in the hedge fund world, discretionary fundamental oriented investing, hedge funds, mutual funds, I think that's how most of the PMs would describe themselves. Value, flat fundamentals, maybe growth, right? But we're always talking about catalysts. What I'm trying to describe is that, yes, catalysts exist from real world structured data signals. It's a catalyst if company XYZ comes out and announces, our guidance was for earnings to be X. We're now saying that our earnings are going to be X plus Y, right? That's a catalyst. A government regulatory action. Lena Khan comes out and says, oh, we're going to bless this merger, or more likely, oh, we're going to take this merger to court. That's a catalyst. Oh, the unemployment rate is whatever, 3.5%, and now it's 3.7%. The catalyst. The point I'm trying to make is that those real world catalysts are either magnified or diminished by the story that's told around those catalysts. And that the impact of the story that's told around the catalyst. Oh, CPI was up. Well, yeah, don't worry about that. After you factor out the energy impact onto transportation or airline ticket, well, that explains away the increase. That was actually a lot of the stuff that was public, not over the CPI that came out to print today, but the CPI print for last month. It understanding narrative catalysts that I think are, at least in today's investment world, so much more important than understanding fundamental catalysts. It makes me sad to say that because I grew up in the church of fundamental value investing. I think most of us on this call did, who's been involved in markets for a while. Our world has really changed to the point where I think narrative catalysts are that much more important than any sort of real world catalyst. So here we can talk about some of those narrative catalysts that at least we're looking for right now.
Yeah, no, let's do that. But before we do that, I do want to. What about for like what I was saying is structural catalysts? Okay, so what I mean by that is, let's face it, that one of the I think very legitimate arguments around why the last decade has been so dominated by U.S. large caps, aside from the sector dynamic with tech, is the structural catalyst of most people's default 401k flows go into Vanguard market cap funds, and it creates this sort of constant bid. So it's not even about narrative at that point. There's literally just, you talk about flows earlier in the conversation. There's this constant buying that comes in, which results in a very top heavy, in quote, market, which in reality is not, you can argue, that much based on true company specific narratives. It's more based on something that's automated.
Michael, there are two sources of alpha in this world: access to information about flow and access to, again, what I think is information about narrative catalysts. Honestly, I think that's it. I think those are your two sources of alpha. And by the way, we have to understand Wall Street. It's a storytelling machine. That is the business of Wall Street, to tell stories that motivate you to transact, to buy and to sell, that motivates you to move your capital from this manager to that manager, that motivates you to transact in this stock and then that stock. That is the business of Wall Street, to tell these stories that motivate you to transact. And that is because the business model of Wall Street is based on flow, not price, flow. Wall Street really doesn't care whether the price of something goes up or down. What all of us in Wall Street care enormously about is how money flows from one place to another, is pooled in one place or another. Wall Street is a flow business, and it's a storytelling business. So the edge when you're on the other side of Wall Street is in understanding flow or understanding storytelling. Period. Full stop.
So let's go into some of those narratives, catalysts that you alluded to.
Sure. Well, I think the first narrative catalyst, and we're starting to see this happen, is that inflation is coming back. You started seeing that probably about 3 weeks ago when crude hit over $90 a barrel. That creates a state of stories and people paying attention to energy prices and the possibility that inflation is coming back. The catalyst I'm looking for is actually, you saw it start to happen in the CPI report today. Because if you notice, one of the drivers for the CPI coming in a little hotter than anticipated was that housing, as measured by this wackadoodle measurement we have called owner's equivalent rent, came in a little higher than expected. This measure of housing, right, it's a crazily lagged indicator, so that our actual inflation rate was well north of 10%, even though our official data, I think we got 8, something like that. And that's because the housing data was lagged. Currently, we're showing this disinflation because the decline in home prices and rental prices that we saw, 6-9 months ago, that's being reflected in the data, the CPI data today. It's a very lagged indicator. In the real world, home prices are going up again. In the real world, rental prices have stabilized and are starting to go up again. We're going to start seeing that reflected in the CPI numbers. I was surprised we saw it reflected a little bit in today's number. What I've been thinking is that come December, January, certainly Q1 of next year, you'll start to see the CPI numbers consistently surprise on the upside because our housing, the inflation that's happening again in home prices starts getting reflected with this lag. So I think that the inflation is resurgent narrative comes back, and you're seeing a little bit today, as input to the CPI start to hit. And there are two of them that I'm looking at. One is on oil over $90 a barrel, creates a state of narrative stories and attention on inflation coming back. And two, if you get home prices reflected in the CPI official print, that also creates a set of stories that inflation is resurgent and coming back. So that's one. Right now we're still in the inflation is over narrative. That's still very dominant. What I'm looking for, like we're seeing today, are cracks in that story and the resurgence of inflation as becoming a narrative. So that's one. Two, I think we need to look at Japan. Right. So last week, last week, the Bank of Japan intervened in the yen. Right. So the yen has been falling like a rock, in large part, I say almost totally, because the Bank of Japan keep their interest rate, their long-term interest rates, artificially low, at the same time as U.S. interest rates have done what they've done, even though inflation is absolutely a problem in Japan. So the Bank of Japan, called yield curve control, have kept their long-dated interest rates, their 10-year JGB, artificially low. And that creates an opportunity. People say, well, I'm going to borrow yen and I'm going to buy dollar securities and I'm going to get this higher rate of interest. The Bank of Japan intervened in the yen when it hit 150. And that intervention had a half-life of about 12 hours. If this is the line in the sand that the Bank of Japan is going to draw, and I think they're going to be tested again on this, I think they're going to have a really hard time defending that line in the sand unless they go back and quote unquote tweak yield curve control, that is, allow their longer dated interest rate to go up another 50 basis points or another 1%. What happens then is that all interest rates, all global long-term interest rates, are going to get a shock higher. So I think it's important to look at Japan from a narrative perspective. What I'm looking for is the first story in the FT or the Wall Street Journal that compares the Bank of Japan today to the Bank of England in 92. Druckenmiller and Soros famously broke the Bank of England over a very similar issue, an exchange rate that was kept artificially pegged, even though the real world made it very difficult for the Bank of England to maintain a credible stance there. So the first story that mentions that, I think that's the start of an entirely new and impactful narrative battle around global interest rate. Related to that is what we're picking up today is a very strong increase in the use of the word and the phrase bond vigilante. So there's no such thing as bond vigilante. It's shorthand for market participant enforcing quote unquote fiscal discipline and not a buyer's strike on treasuries. There are all these words and phrases that go along with the concept of bond vigilantes. We are absolutely seeing that sort of language with a significant turn upwards. Like oil over $90 a barrel, right? Like home prices getting reflected in CPI report. This sort of language forces people to pay attention. What's a bond vigilante? Oh, I've heard of bond vigilantes. That was back in the 1970s when inflation was really a problem and interest rates went really high. This is what I mean about how changes in narrative world end up focusing our attention and creating behavioral changes in actual market prices. Those are the ones that I'd focus on right now, those three, and they're related narrative catalysts. A return of inflation is increasing, that narrative. A focus on the Bank of Japan is going to lose credibility and cannot maintain yield curve control. That's a catalyst that I think we really need to be paying attention to. And number three is the rise in discussion about bond vigilantes and the necessity of enforcing discipline on fiscal issues. By the way, I think all of these things are true. I think there should be more discipline on fiscal issues. My point is you're going to hear a lot more about it, particularly as we go through the 2024 election cycle, and that storytelling and the attention we pay to it creates its own reality.
Ben, for those who want to track more of your thoughts, they get access to some of your research. Where would you point them to?
EpsilonTheory.com. On Twitter here at Epsilon Theory, where we're all Epsilon Theory all the time. We've got podcasts. We publish a lot. Most of it is available outside of the paywall. And then we have both publications and investment strategies for our institutional clients.
But again, please make sure you follow Ben Hunt. Appreciate everybody that joined. I have another space coming up tomorrow. And as always, this will be an edited podcast soon enough under Lead Lag Live. Ben, I appreciate the last minute on this. I always enjoy listening to you.
My pleasure. Thanks for having me, Michael.